Hello, fellow traders. Tis I, TheRumpledOne, coming to you on Tuesday, March the 19th. The year's 2024. Let's talk trading. Trading with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. Walmal, yesterday, we had talked about the H4 chart, and one of the traders wanted us to talk about H4 from a risk-reward, perspective. I'm not 100% sure what they meant, but maybe you have an idea?
I had said something on, maybe not yesterday, but I've said in the past about when you trade the higher time frames, one of the things that naturally comes out of that a lot of times is, and this isn't 100% because nothing's 100%, you wind up having to put your stop losses further away just because of when you're trading a higher time frame, the movements are so much bigger. And a lot of times what will happen is, let's say I'm trading, crossovers of the H4, which by the way is actually what I did do today in order to make money, but that's neither here nor there. But what can generally happen is that, okay, let's say I'm trying to, like right now my H4 open is at 2699.0. Okay, and let's say I was trying to trade the open on this thing, and 30 minutes ago well, not 30 minutes ago, but at the 30-minute mark, roughly, for the we did cross over it. Okay, and next thing you know, it bounced back to the other side. And so right now, I'd be out of the trade with a loss because, the reality is that it bounced off of it by about 4 pips right now. We're 4.1 pips off of the H1 open.
Okay? H1 or H4?
H4.
Okay.
Because my H4 and my H1 are the same on my chart right now.
Well, the reason I ask is I got a H4 open at 2670, and the price is at 2694.
Yeah, but so my H4, I got a brand new H4 at the top of the hour, so that's probably the difference. That's probably why. Well, that would be my guess.
Well, I should have gotten one at the top of the hour, but I didn't. Oh, that's probably because of the time change.
Right, exactly. Yeah, your broker probably didn't make a time change. Well, not sure, or maybe it did make a time change and mine didn't. Whatever happened 2 weeks ago when we had the time change occur in the U.S. But in any case, we're 4 or 5. We were 4 or 5 pips away from that crossover open, and now we're making our way back. Well, what does that mean? Generally speaking, I've had my stops pretty tight. But in this scenario, if I'm going to be trading that open, well, the reality is before the H4 goes and picks a direction, it may move 10, 15 pips in one particular direction before it runs 30 pips in another direction. So that's kind of what I mean by, you can't keep your stops nearly as close because of that. And you throw up an H4 chart and you start looking for, as the gurus out there say, a logical place to place your stop, and you start looking for those places, and next thing you know, you can be substantially further away. Now, there's another way to play the H4 open where you don't have to do that, and that's the way I do it. And it's this morning I scalped off of the H4. Why? Because what I saw was that price was constantly crossing over that line. It was a threshold. It was, as they said back in the day, it was a line drawn in the sand. So what was I doing? I was trading when I crossed the line. I would go and take the trade in that particular direction, and was only looking to get, 2, 3, 4 pips, whatever I could get. And as soon as it started to turn around on me and come back the other way, I got out, but by doing that way, I have to keep my stops pretty tight. Now, luckily, I haven't had any losses today, but I can tell you right now that, I wouldn't have let a trade go more than probably 4 pips against me. And just call it a day on that trade. And the nice thing about it was I don't know how many trades I have today. I don't have very many trades, to be honest, but I made core with it. I got 1, 2, 3, 4 trades this morning, but it was just a nice little way to go and do it. So what I was keeping my stops close, and what I was doing was when the H4 line got crossed, because the nice thing about it is, generally speaking, not always, but generally speaking, when the H4 line does get crossed, the open line in particular, okay, it likes to cross it by at least 3, 4, 5 pips, and so you can make some money that way. The first hour is the hour that it's trying to figure out and establish that line. Yeah, the line is drawn on the chart already, but it's establishing that line. So you generally don't get that big of a movement off it. But by the second and third hour, you get some nice moves across that line. At least that's been my experience.
Yeah, if it crosses the line. I like to usually refer to H4 as a freight train because if you look, you can see some really big candles happen, usually once or twice a day relative to the other H4 candles. Like yesterday,
Right.
you can see we only had maybe a couple candles like that. But today, it's pretty much a no-brainer, obvious to see that big push, at least on my previous H4, really shot down about 30 pips or so.
Right. But if you, at the same time, what's really cool about the H4 is, and it doesn't happen on every candle, but at least again on my chart, my previous H4, it shot down from its open and actually ran up. How many pips is that? It ran up 20 pips. Is that right? Yeah, ran up 20 pips. And then what it did was it ran down. It's hard to see this on this chart. It ran down 20 pips across the open. So it actually came down 40 pips. And then it actually wound up closing again above. It ran back the other direction and closed about 10 pips up. And that's one of the things that you have to be very careful with the H4s because, it can be a freight train. And the problem is that sometimes it's a freight train back against itself, and that's trading, So my point is that once you see that freight train come to a stop and it's making the decision to go the other way, well, guess what? The train may have started in Atlanta and went up to Charlotte. Well, guess what? It's now coming from Charlotte back to Atlanta.
Yeah, exactly.
So you got to be careful about that, and just and protect yourself, And that's the reason why in my opinion, anyway, you can't just rely on one thing. So what do I mean by that? What I mean by that is that I'm going to go and trade. If I'm trading H4 crossovers, and that's all I'm trading is H4 crossovers, well, that's fine. I can go and do that and just go and just take the crossover. And, if I make 3 or 4 pips, I make 3 or 4 pips. If I lose 3 or 4 pips, I lose 3 or 4 pips. And just say, you know what, over time, I will go and make more than I lose. And, and it may look sloppy on paper, but for the most part, it'll work out in the end. The wash, as they say, the wash will come out in the rinse, right? And so you just go and deal with that. On the other hand, if you're trying to go and make the big picks, because just as a reality check, my hourly chart, for my ranges, I got 14, 19, 14, 14, 25, 18. It's going back a couple hours. On the other hand, on my H4, I got 14 for this hour so far, which matches the hourly. And then I got 41, 35, and so if I want to go and make those big moves that you see there, well, that means I got to stick in it longer. But the problem is that I also got to be careful that it's not a big move against me. And so I better have some things in place that are telling me, okay, this thing, the train is coming into the station and it's coming to a stop and it's getting ready to switch over the tracks and go back the other way. And so I need to go and make sure that I'm ready for that. And so that means, there are a couple of ways you can do that. One, you do your set and forget thing. That's great, but then you better go out there and have a really good understanding as to how far the H4 actually runs on your particular instrument. And you've got that, and you need to have that pretty well tuned in, and you need to be going and running those stats all of the time so that you are really tuned into that idea of what's going on. Or secondarily, what you can do is you can sit out here and watch it and see what it's doing. And when the lower time frames are telling you, hey, this thing is coming to you, this run is coming to an end, it's slowing down, that way you can get out. Now, the advantage of that method is that you can sometimes optimize how much you win. The disadvantage is you can also miss out on a bigger move if that was just a pause.
Yeah, and one of the other methods, you were talking about the H4 crossover, and I'm pretty sure you meant the H4 open cross. One of the things
Correct.
you want to also, you can almost trade the H4 like a daily, and what I mean by that is, one of the things statistically, the wick zone. So if you use H4 wick zones and take those trades, it's like once price gets in the H4 wick zone, it usually doesn't stay in there either. And so what'll happen is you can just look at it. On my chart, you can see we had the open. It barely got into the lower wick zone of the previous H4, turned around, turned the candle green, went all the way up to the previous H4 open, got into that upper H4 wick zone, then came right back out. And you can call that hairy hindsight, but all you have to do is look and see. So you just basically, if you go short, at the top here, and then all of a sudden it goes the other way, then you just use the edges of the wick zone as your stop. So if you were going long at the previous high, then right here at the top, that maybe a pip below the top is where you put your stop. And sometimes you might even want to stop in reverse. That's always one thing. Or for the, I guess, more sophisticated or experienced traders, you could also put a hedge on and then play it again. In other words, if you went long at the previous high and it reversed out of you, came through the middle of the wick zone, goes to the other side, you could actually possibly double up, and then if it makes that big move, then you're okay. And then you can almost do that ad infinitum.
Right. Yeah, and the nice thing about that is it gives you that ability to go and do that, take advantage of that. Of course, there's a cost to that because you're putting on another trade, and there's always a cost associated
Right.
with putting on another trade. But you have to, and that's what, 3/4 of trading is preparation, right?
Right.
So you got to sit down and do the analysis and see, does it make sense for me to do that with my style of trading?
Right. And and one final note here, looking at the pivots, you can see price even shot through the daily S4 and turned around. So statistically, how often does price hit, S4 or S3?
Yeah.
And so right there, yeah. And then also you look at the range and the distance, in this case from indicator 2, which is something that we've done before, and know that, it's about time for it to come back. So there's many things, that you can pull in if you want to trade these higher time frames. And usually if your method is robust, it doesn't matter the time frame. It's still going to pay out. Now, once again, you run statistics, and some time frames pay out better than others. So for example, if you were looking for a cover, you want to look for an M30 candle for a cover versus an H4. So, fellow traders, you know what? The fastest 15 minutes in trading is just about over. So always remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.